Welcome back to 5 charts and 5 charts only. The title speaks for itself. So let's get right into it, starting with the S&P 500, specifically the recent upside targets that have both been in place and have recently got acquired. So the first one we're talking about is 65.55. Now this was hit, as we can tell, in the beginning of September here. And this one has been with us for quite some time. In fact, we've had 2 upside targets that got triggered here on May 12th. We can see the gap higher. Never even got tested. We like to show this risk zone as a matter of telling us when things potentially could get negated on the way down. And so needless to say, that hasn't, or that did not happen back then, with not even getting back to the neckline, which it broke out of, let alone the pretty high level right shoulder, right? And so that means that we've had a clean breakout. And even though it took a while to get acquired, it did, and that was pretty substantial. Now, it wasn't that easy in the fact that we got a lot of pushback when we first talked about it. Now, let's look at what it appeared like during that time frame, right? This was the breakout zone here. And so the S&P was already up about 18% from that time. Remember, 18% in 4 weeks, and it took 4 months to get to the target. So 18% in a 4-week period is extremely fast pace. And as we know, because of the exceedingly high volatility on the way down, it was met with a huge amount of buying, at least initially. And so that brought the S&P all the way back up to near the 5,800 zone. And remember, that's where this bearish flag-like formation failed, right? So we all have recency bias, so you remember that. And if you recall, May 12th, about a month removed from when things turned from a tariff perspective, we still really had no idea how that was going to play out over the longer term. So that was still in the back of everyone's minds. Now, also, if we were able to get through that area, we still have to contend with this entire zone all the way up to 6,100. So a lot of supply, and especially tough considering that the S&P failed right at 6,100 5 different times from late 2024 to early 2025. So there was really not a lot of confidence or belief that the S&P could get right through that, let alone right away. Let's not forget as well that that meant gaining an additional 15% from this point. And again, picturing something that hasn't happened yet, much higher than what the market has been before, coming back from something that we thought would be with us for quite some time, all made that target seem improbable. As we know, all those potential obstacles were not factors. We eventually got to that point. So along the way, we've had also smaller formations pop up as well. And as you recall, there were a few that actually failed here. It's tough to see this on the daily chart, but we were showing it sometimes on the 2-hour time frame. And some of the marginal breakouts just didn't work out. And so again, very small, so not a big deal overall. But all of these are factors and things we consider as potential for the character to potentially change, meaning that if we have bullish breakouts fail, it's obviously not a good sign and potentially could lead to the construction of bearish formations. And that's really what we saw at the end of 2024 into the beginning of 2025, when, again, there was breadth that started to deteriorate, and that led to those breakouts failing and eventually those bearish patterns working and the waterfall decline happening after that. So with the latest breakout happening in the middle of September and relatively quickly hitting the upside target of 66.65, that's a good sign, right? There's another upside target having been acquired. That's breakout target number 4, right? We still have more above us, and that is the 67.45 objective. Again, this was also triggered on that May 12th breakout, and it was initially tested soon thereafter and held right away, so it continues to be with us. As of the morning of Tuesday, September 23rd, the S&P was within 1% of getting that acquired. Really, like we talked about before, the only way that could actually be attained is if these other patterns first were able to get their objectives acquired as well. Remember, smaller patterns that work eventually form bigger ones, and that altogether is what helps construct long-term uptrends, right? So that means the negative is that we only have one more pattern left. And again, we're within about 1-2% of that right now. And once that gets acquired, we just have to wait to see if any more get constructed, right? That has been happening along the way. But again, we look back to 2024, we finally had that 6,100 target hit that was in place for 11 months. He said it was time to reset. What do we need to have bullish formations constructed? We need two-way volatility. We need back and forth movement. That's how these huge formations were constructed in the first place, not just within the S&P 500, with other areas as well. So we're at the stage where, again, both bulls and bears expect some sort of back and forth movement to come once more. If and when that happens, we'll have to see how that looks on the chart. And so this is what we track, again, from the bullish pattern perspective, but we also can use Fibonacci extensions. And if we look at that from this perspective, again, using the high in February and the low in April, that gets us to a 1.618 retracement up to around 69.50. So about 200 points higher than our pattern target. So again, this continues to be out there as well. Okay, number two, technology. We know there's been driving a lot of the price action recently, especially as breadth has been subpar. So in terms of the XLK, just looking at the last 2 weeks of performance, and not surprising, it led 2 straight weeks with gains of 3% as well. And overall, that led to a 4-week winning streak. Let's not forget, many of the large cap growth names took a break. So now seeing that break followed by a 4-week winning streak is a good sign longer term. And this is all of the 4-week winning streaks that have taken place since 2020. And so one obvious takeaway from this is that we typically don't see a lot of 4-week winning streaks when the market's moving lower, right? Only happened one time during the thick of the 2022 bear market. That happened during that really strong summer bear market rally, which ultimately failed. From that point, it took a while to get more of them, but after the low in 2023 to the end of 2024, they started to appear once more. And as we can tell, we still had a few at the end of the year last year. So that's a good long-term sign, especially as we continue to compare the XLK and many others to what happened in 2020, 2021. So one of the reasons that was able to occur was coming out of that back and forth movement from July through August. We had potential topping pattern form. We were talking about this at the time. It was an important track because it was hovering right at the 50-day moving average as well. Last time we saw that happen was a failed smaller double top back in June as well, which gave way to the next up leg. And so needless to say, when bearish patterns fail, that's bullish, and this is exactly what happened there because the market was able then to rally. So another way to look at this price action, of course, is viewing it from a trading box perspective. And so as we can tell, the XLK has now logged 6 straight trading box breakouts, with the next one here potentially taking place right now. And so again, on the way up, it appears that everything is up in nearly a straight line, with there being hardly any pullbacks along the way. That's easy to conceive, but as we can tell here, it's been much more about digesting sharp moves, but shorter term bursts, and then having another consolidation along the way, taking advantage of that once more. So this shows us that, we talked about how bullish patterns form uptrends. Uptrends are also about seeing those digestive phases resolve to the upside, or said differently, they turn into continuation patterns as opposed to reversal patterns. So we're also looking for one of these trading boxes eventually being resolved to the downside, right? That could also result in something appearing like a bearish head and shoulders pattern. If and when that does, that could tell us, again, the character has changed. Maybe we need some more time to regroup. So far, we have to respect these trading boxes for what they are. Once again, they are continuation patterns. Okay, so number 3, 10-year yield. Obviously in the news, especially after rate cuts, and we know it, after that, we got a little bit of a bounce. This is a weekly chart of the 10-year yield going back to 2022. As we can tell, even though it's been falling recently, it's been riding this trend line, showing higher lows along the way, but at the same time, showing lower highs. So really one really big triangle pattern. So needless to say, if the same type of bouncing action occurs now as we saw over the last number of times it encountered this line, then pretty substantial higher movement rates, which I don't think a lot of people believe can happen. And now, especially since the Fed has now started to cut rates themselves. Now, for that to occur on the daily chart, this is what it's contending with. Again, we can also group rates in terms of trading boxes. So far, on the way down, all that consolidation that occurred right above the 4 zone, we're seeing the bounce to. Not surprising, it came after being oversold, but now faces a real test, right? 10-year yield staring back up at 4.2%. Really clear resistance, form of support here, just as the weekly or the daily RSI gets back to the 50 zone. And as we can tell on the way down here, it's not surprising that that RSI has had a hard time getting it back above that 50 level. And if that changes, that could support eventually overtaking that 4.2 area here and eventually getting back above this downtrend line. These are all a few steps ahead, but keep in mind if that does happen, of course, that could be a headwind to the equity market, which of course is short-term extended right now. So if you like this content, I urge you to check out our free Cap Notes newsletter, which is on Substack, where we go into a lot more detail about a lot of these points, looking at the S&P 500, other ETFs, chart trades, and a lot more premium content. Again, that is at capnotes.substack.com. So number 4 is gold. As we know, continues to do great. And this is a picture of what it looks like through last week. Just another breakout. Right? We've seen it before. This is going back to 2023. All looks very similar so far, with a missing link at this point, just having this extension last longer. Right? As we can tell, not only do we get the emphatic moves higher, we got immediate upside follow through, which then extended. We can see both of those factors profiled here on the 14-week RSI, that not only did that indicator get to overbought territory, it got pretty high into overbought territory, as we can tell by the shade here, into the mid-70s, and stayed like that for weeks at a time. Where right now, we're about 2 weeks into being overbought. So if this rally were to then mimic what we've seen before, it just means that we should expect more upside until it changes, right? And so that has really extended gold's advantage in terms of price performance year to date versus Bitcoin, which of course now is rolling over a bit, and the S&P 500, which still continues to make new highs, but as we know, those have just been small moves along the way where gold has really taken off. And don't forget, gold and Bitcoin were really right neck and neck as of just a few weeks ago in August as Bitcoin topped. So it's a good segue to talking about number 5, which is Bitcoin. And so the biggest thing so far is that it looked like it was finally trying to form a bullish pattern, take advantage of it as last week came to a close, and that would have produced a target of 127.6. It did not happen, of course. It was didn't even get a close above that. And now on the reverse, we can call this a negated pattern, but really it wasn't even live for over a few hours. So it never really got a chance to do so. More importantly is what this has done to the other charts within Bitcoin. And so that prevented this latest downward sloping trading channel breakout, or we can call this a falling bullish wedge pattern as well. And all along the way up until this point, we saw breakouts, we saw extensions, and even though some of them didn't get really that far in terms of following through, the ensuing breakouts all worked out. So this is going to be important. Again, it has some leeway. It can maybe extend longer. It wasn't ready yet. And we know that, number 1, seasonality gets better for crypto overall into October or November. So if it needs to pull back a little bit more to get to that point, and then we'll see demand, so be it. But at this point, we just have to identify the next bullish pattern that can actually work out. Now, in terms of one that's still alive for now, is this one, as we have talked about in the past. This produces a target of 142,000. We got an initial breakout that looked very similar to what was occurring last October, November, but so far we just haven't had that upside follow through yet. And that's obviously what we need to keep this pattern in play. So lastly, what we'll be looking for now is if and when this turns into a bearish formation. Remember, along the way here, the market has been rallying. It hasn't been a straight shot higher like we've seen in the past with Bitcoin rallying, but it has done a very good job of avoiding these topping patterns from completely playing out. see some pretty sharp moves, of course, but just when this was about to break lower, that's when buying flood back into the system. And of course, that will be something we want to see once more if Bitcoin has to fall more than it has so far already. So if you like these 5 chart series, let me know in the comments below. Check out the last 2 we just did over the last 2 weeks right here.